Let me tell you something plain, the way a trader ought to hear it. Everyone comes into this game asking the same question, whether they say it out loud or not. Where is the edge? They look for it in tips, in indicators, in someone else's opinion. They think the edge is hidden somewhere outside themselves, like a secret door that only opens if you know the right knock. But have you ever noticed how the market doesn't care who you are or what you believe? I learned early that the market rewards only one thing: being right at the right time and staying with it. That's it. Not intelligence, not effort, not hope. The edge is not brilliance. It's alignment. It's knowing when the market is ready to move and having the discipline to move with it. Ask yourself honestly, are you trading the market, or are you trading your opinions? Most men think trading is about activity. They believe if they're not in the market, they're missing something. That kind of thinking empties accounts faster than bad analysis. My biggest profits never came from being busy. They came from sitting still, watching, waiting, and then acting without hesitation when the time came. Can you sit on your hands when nothing is happening, or does the silence make you uncomfortable? Your edge begins with recognizing that prices move for their own reasons, not yours. Charts don't lie, but traders do, mostly to themselves. A chart is simply a record of human behavior, fear and greed drawn in lines. When you learn to read that language, you stop arguing with the market. And once you stop arguing, you stop losing so much money. Isn't it strange how most losses come from insisting the market is wrong? I never made money by predicting tops and bottoms. That's a fool's game, dressed up as skill. I made money by recognizing a trend and staying with it longer than felt comfortable. The edge is not being first, it's being right and staying right. How many times have you taken a profit too early just to feel smart, only to watch the market run without you? There's a point in every move where the market tells you what it intends to do. Not loudly, not clearly, but enough for the disciplined eye. Volume speaks. Price behavior speaks. They always do. But they don't speak to the impatient. The edge comes from listening without emotion. Can you hear what the market is saying, or are you too busy telling it what it should do? Most traders spend their time trying to avoid losses. That's backward. Losses are the cost of doing business. The real danger is not a small loss, it's a big one. Your edge sharpens the moment you decide that no single trade matters much. When you stop needing any one trade to work, you start trading properly. Isn't it true that desperation is what really ruins judgment? Money management is not the dull part of trading. It's the heart of it. Anyone can find a decent setup now and then. Few can size a position correctly and live to trade another day. The edge isn't just knowing when to enter, it's knowing how much to risk. If you don't respect risk, the market will teach you respect in the harshest way possible. Have you noticed how the market always collects tuition? Your mindset shows up on the chart, whether you admit it or not. A fearful trader sees danger everywhere. A greedy trader sees opportunity where none exists. The market reflects your weaknesses back to you. That's why trading is such a brutal teacher. It doesn't flatter, it exposes. The edge comes when you stop trying to feel good and start trying to trade well. Do you want comfort, or do you want consistency? I've seen men with perfect systems fail because they couldn't follow their own rules. I've also seen simple methods make fortunes because they were applied with discipline. The edge is not complexity. In fact, complexity is often a disguise for confusion. The market rewards clarity. One idea, well executed, beats 10 ideas poorly managed. How many rules do you break without even noticing? Patience is talked about often, but rarely understood. Patience is not passive. It's active waiting. It's studying price, watching behavior, and doing nothing until the odds shift in your favor. The edge grows in those quiet hours when you do not trade. That's when you prepare your mind. Are you willing to wait for your pitch, or do you swing at everything thrown your way? There's a difference between confidence and stubbornness. Confidence comes from experience and discipline. Stubbornness comes from ego. The market punishes ego without mercy. When you're wrong, you must admit it quickly and cheaply. That is not weakness. That is survival. The edge is knowing that being wrong is inevitable, But staying wrong is optional. How fast do you get out when the market proves you wrong? Wealth in trading is built the same way trends are built, gradually, then suddenly. Small gains compound. Good habits compound. So do bad ones. Every decision you make leaves a mark, whether you see it or not. The edge is cumulative. It's the sum of thousands of correct actions, most of them unremarkable. Are you focused on the next trade, or on becoming the kind of trader who can last? When you stop chasing excitement, trading becomes clearer. You stop needing action, and you start demanding quality. You begin to see that your real competition is not the market, but your own impulses. Control those and the market becomes manageable. Ignore them, and no edge will save you. Most traders come into the market believing the edge is prediction. They think the man who can see the future must be the man who makes the money. So they chase forecasts, targets, opinions, and clever explanations. They want to know where price will be tomorrow, next week, next month. But the market has a way of humbling that kind of thinking. It doesn't reward prophecy. It rewards perception. The real edge is not predicting what will happen, but recognizing what is happening while it's happening. Have you ever noticed how the market moves just fine without asking for your opinion? Prediction appeals to ego. Recognition demands humility. When you predict, you are telling the market what it should do. When you recognize, you are listening to what it is doing. That difference may sound small, but it's the distance between consistent profits and repeated frustration. The trader who predicts fights the tape. The trader who recognizes follows it. And the tape always wins. How many times have you held onto a losing trade simply because you were sure you were right? Recognition starts with price itself. Price is the final judge. News, theories, and explanations may decorate the move, but price tells the truth. A stock advancing on strong volume is not asking for your approval. It is announcing demand. A market failing to rally after good news is not confused. It is revealing weakness. The edge lies in seeing these signals clearly, without trying to explain them away. Can you accept what price is telling you, even when it contradicts what you believe? Prediction requires certainty. Recognition accepts uncertainty. That's why most traders struggle with it. They want guarantees. They want to know before they act. But the market never offers certainty, only probabilities. Recognition means acting when the odds shift in your favor, not when the future feels safe. The trader who waits for certainty usually arrives late, pays too much, and exits too soon. Have you ever noticed how the best moves feel uncomfortable at the start? A trend does not begin with an announcement. It begins quietly, often when most traders are still arguing about the last move. Recognition means seeing the change in behavior before it becomes obvious. Higher highs and higher lows are not predictions, they are observations. Increased volume is not a promise, it is evidence. The edge grows when you train yourself to respond to evidence instead of anticipation. Are you watching the market, or are you watching your hopes? Many losses come from predicting reversals. Traders love tops and bottoms because they make one feel clever. But cleverness is not a substitute for discipline. Recognition tells you that trends persist longer than logic expects. It tells you to stay with strength and avoid weakness, even when it feels crowded or boring. The market pays those who align with momentum, not those who try to outsmart it. Why do so many traders insist on selling strength and buying weakness? Recognition also applies to yourself. You must recognize when you are trading well and when you are not. After a series of losses, the market hasn't changed, but you have. Your judgment may be impaired. Your patience may be thin. The edge includes knowing when to step aside. Prediction keeps you trading. Recognition sometimes tells you to stop. Can you recognize when you are no longer objective? The same is true with profits. A trade moving in your favor gives signals along the way. Tight consolidations, steady volume, orderly pullbacks. These are signs of health. Prediction says, this is enough, take it. Recognition says, the market hasn't told me to leave yet. Big money is not made by grabbing small gains, but by recognizing when conditions remain favorable and staying put. How often do you sell just to relieve the tension? Markets repeat themselves, not because history copies itself, but because human behavior doesn't change. Recognition is pattern awareness. It is seeing accumulation instead of guessing breakouts. It is sensing distribution instead of predicting crashes. These patterns are not exact, but they rhyme. The trader who studies them learns to recognize familiar behavior, not forecast exact outcomes. Are you studying price behavior, or are you memorizing opinions? Recognition simplifies trading. You stop asking endless questions and start observing a few important things well. Is price advancing or declining? Is volume confirming or diverging? Is the market acting strong or weak? These answers don't predict the future, but they guide your actions in the present. Trading happens now, not in tomorrow's forecast. The edge is acting correctly in the moment. Can you stay present while money is on the line? The market constantly tests your ability to recognize rather than assume. A stock may look strong but fail to follow through. Recognition tells you to step aside. A market may look weak but refuse to go down. Recognition keeps you from pressing shorts. Prediction locks you into bias. Recognition keeps you flexible. Flexibility is survival in this business. How attached are you to being right? Recognition also shapes risk. When you recognize strength, you can risk small for potential large reward. When you recognize weakness, you avoid unnecessary exposure. Prediction often increases risk because it creates conviction without confirmation. The trader who predicts feels justified in holding on. The trader who recognizes is quick to exit when behavior changes. Losses stay small, not because the trader is lucky, but because he listens. Over time, recognition builds confidence of the right kind. Not bravado, not overconfidence, but quiet trust in your ability to read the tape. You stop needing to know what will happen next. You focus on responding correctly to what is happening now. The market becomes less mysterious and more mechanical. Not easy, but honest. Recognition does not come from one book or one system. It comes from watching the market day after day, learning how it breathes, how it moves, how it hesitates. It comes from losing money and understanding why, not explaining it away. The edge sharpens slowly through observation and restraint. Trends don't reward activity, they reward restraint. That's the part most traders never fully accept. They believe money is made by action, by constant decisions, by always doing something. But the market doesn't pay you for effort. It pays you for being aligned and staying aligned. A trend is not a moment, it's a process, and the trader who understands that learns early that sitting still is often the hardest and most profitable skill in the business. Have you ever noticed how the biggest moves happen while most traders are busy second, guessing themselves? The beginning of a trend rarely looks impressive. It often feels uncertain, awkward, even dull. There's no excitement in it yet. That's why most traders don't trust it. They want confirmation stacked on confirmation. They want proof beyond doubt. But by the time doubt disappears, much of the move is already behind them. The trader who profits is not the one who feels comfortable, but the one who recognizes strength early and then has the patience to let it work. Can you stay with a position when nothing dramatic is happening? Once a trend is underway, the real work begins. Not entering, but holding. Holding through small reactions. Holding through days where nothing seems to happen. Holding while your unrealized profit fluctuates and tests your nerves. The market uses time as a weapon. It shakes out the impatient not by violence, but by boredom. Most traders don't lose money because they're wrong about direction. They lose it because they can't stay put. How long do you usually last once you're in profit? A healthy trend doesn't move in a straight line. It advances, pauses, pulls back, and advances again. These pauses are not danger signs, but tests of discipline. The trader who understands trends sees these pauses as normal behavior. The trader who doesn't sees them as reasons to exit. Fear whispers that the move is over. Greed whispers that the profit might disappear. Both voices push toward action. Sitting still requires ignoring both. Are you trading the market, or are you reacting to your emotions? The temptation to take profits early is powerful. A small gain feels real. It feels safe. Letting it run feels risky, even when the trend is clearly intact. That's one of the great ironies of trading. The safest trades feel dangerous, and the most dangerous trades often feel safe. Trends reward those who can tolerate discomfort. The market doesn't hand out large profits to those who need constant reassurance. Have you ever cut a winning trade just to feel relief? Trends also expose the difference between hope and observation. Hope wants more. Observation watches behavior. When a trend remains strong, price respects support, volume behaves properly, and pullbacks are orderly. None of this guarantees continuation, but it offers information. The trader who sits still is not passive. He is observing closely, ready to act if behavior changes. Sitting still does not mean ignoring risk. It means not inventing reasons to act. Can you tell the difference? Many traders believe the hard part is finding the right entry. That's only half the job. The other half is not ruining it. A good entry followed by poor holding discipline produces average results at best. Trends don't unfold on your schedule. They unfold on the market's schedule. If you impose your timing on them, you cut their potential short. The market rewards patience, because patience aligns with how trends actually develop. How often do you impose your own clock on the market? There is also a psychological shift that happens when you learn to sit still. You stop looking at every tick as a verdict. You stop needing constant feedback. You begin to think in terms of structure instead of noise. Small fluctuations lose their power over you. This detachment is not indifference. It's maturity. It allows you to stay with the larger move instead of being shaken out by every minor reaction. Do small moves still feel personal to you? Trends are where real money is made because they allow gains to compound. One good trend can cover many small losses and still leave a substantial profit, but that only happens if you let it. Exiting too early forces you to find more trades, take more risks, and pay more costs. Sitting still reduces errors because it reduces decisions. Fewer decisions mean fewer mistakes. That's a simple truth many traders overlook. The market often tests conviction by moving sideways after a strong advance. This is where impatience peaks. Nothing is happening, yet something is at stake. The trader who understands trends recognizes this as digestion, not failure. The trader who doesn't starts imagining reversals that haven't occurred. Sitting still during these phases feels unproductive, but it's exactly what the trend requires. Can you allow the market time to do its work? It's important to understand that sitting still does not mean stubbornness. If the trend breaks, you must act, but action should be triggered by evidence, not anxiety. A violation of structure, a clear change in behavior, a loss of momentum that is confirmed. These are reasons to exit. Feeling nervous is not. The trader who sits still is decisive when it matters and inactive when it doesn't. That balance is the edge. Trends also teach humility. You don't control them. You participate in them. When you accept that, you stop trying to squeeze every last dollar out of a move and focus instead on staying aligned for as long as conditions remain favorable. This mindset reduces stress and improves results. The market does not reward force. It rewards cooperation. Over time, the trader who learns to sit still begins to see trading differently. He stops chasing every opportunity and starts waiting for the right ones. He understands that one strong trend, properly held, is worth more than dozens of small trades. His account grows not from constant motion, but from correct positioning and patience. The hardest part is doing nothing while doing everything right. Before a trader ever thinks about making money, he must learn how not to lose it. That idea sounds simple, almost obvious, yet it's ignored more than any other rule in speculation. Most traders come into the market focused on profits. They measure success by how much they can make, how fast they can grow an account, how quickly a trade moves in their favor. But the market has a way of reminding them that money must first be kept before it can be multiplied. Capital preservation is not defensive thinking. It is offensive survival. Have you ever noticed how quickly opportunity disappears once capital is damaged? The market offers endless chances, but it demands one thing in return: staying power. Without capital, there is no next trade, no second chance, no recovery. That's why preservation is the first profit. It keeps you in the game. A trader who avoids large losses gains something more valuable than a winning trade. He gains time, and time is the one resource the market always charges for. How many traders do you know who were right once, but gone forever? Losses are unavoidable. Anyone who trades long enough will lose money. That's not the problem. The problem is uncontrolled loss. Small losses are business expenses. Large losses are business-ending events. The trader who understands this stops fearing losses and starts fearing damage. He stops asking how much he can make and starts asking how much he can afford to lose. That shift alone separates professionals from amateurs. Do you size your trades to survive being wrong? Preserving capital requires humility. It requires accepting that no setup is guaranteed, no analysis is foolproof, no opinion is immune to being wrong. The trader who believes too strongly in his ideas risks too much. Conviction without protection is dangerous. The market punishes certainty more harshly than ignorance. When you protect your capital, you acknowledge that the market can do anything at any time. Are you prepared for that reality, or do you assume this time is different? Many traders think preservation means missing opportunity. They believe tight risk controls limit upside. In truth, the opposite is usually the case. A trader who preserves capital can take the next trade with clarity and confidence. A trader who damages capital trades from fear, urgency, or revenge. Preservation keeps the mind clear, and a clear mind sees opportunities that panic overlooks. Have you noticed how bad trades often follow big losses? Capital preservation also means knowing when not to trade. Every market has periods of clarity and periods of confusion. During confusion, preservation is profit. Standing aside is not weakness. It is discipline. Cash is a position, and sometimes it's the best one. The market doesn't expire. You don't need to trade every day to be successful. You need to trade well when conditions are right. Can you stay out when nothing makes sense? Risk management is the practical side of preservation. It shows up in position sizing, stop placement, and exposure. It's not exciting, but it's essential. A trader who risks too much on any one idea is gambling, not trading. Preservation demands consistency. Same risk logic, same discipline, trade after trade. The market rewards those who respect its power. Have you defined your risk before you define your reward? There's also a psychological side to preservation that most traders overlook. Protecting capital protects confidence. A string of small losses can be endured. A single large loss can change how you think, how you act, how you see the market. It can make you hesitant, reactive, or reckless. Preservation keeps emotions stable. Stability leads to better decisions. Better decisions lead to long-term growth. How often do emotions interfere after a big hit? Preservation forces selectivity. When risk is respected, you become choosier. You stop trading marginal setups. You stop forcing action. You wait for alignment. This naturally improves trade quality. Fewer trades, better trades, smaller losses. That combination doesn't feel exciting, but it compounds over time. The market doesn't reward excitement. It rewards endurance. Are you trading to feel something, or to build something? The irony is that traders who focus on preservation often end up making more money. By avoiding major drawdowns, they allow profits to compound uninterrupted. Compounding cannot work when capital is repeatedly damaged. Large losses create holes that require extraordinary performance just to recover. A 50% loss requires a 100% gain to break even. Preservation avoids those traps. Do you understand the mathematics of loss, or do you ignore it? Preservation also teaches patience. When capital is protected, there's no urgency to act. You don't need to chase moves. You don't need to jump in late. You wait for your moment. This patience aligns you with the market instead of putting you in conflict with it. The market always moves more slowly than fear suggests, and faster than hope expects. Preservation helps you navigate that tension. A trader who survives long enough begins to see preservation not as caution, but as confidence. He knows he can take a loss and come back tomorrow unchanged. He knows no single trade defines him. That mindset frees him to trade objectively. Objectivity is impossible when capital is under threat. You cannot think clearly when survival feels uncertain. Preservation removes that pressure. There's a quiet strength in knowing your downside is controlled. It allows you to hold winners longer, to let trends develop, to avoid emotional exits. Preservation and profit are not opposites. They are partners. One creates the conditions for the other. The trader who ignores preservation may experience flashes of success, but they rarely last. The market will always offer another opportunity, but it never refunds lost discipline. Once capital is gone, lessons become expensive. Those who last learn early that protecting what they have comes before chasing what they want. Capital first. Most traders believe skill is what gets tested first in the market. They think charts will reveal whether they're smart enough, fast enough, or informed enough. But the market has a different order of exposure. Before it ever tests your strategy, it tests your mindset, and it does so immediately. The first trade doesn't just show you how price moves, it shows you how you move. The market exposes fear, impatience, greed, and insecurity faster than any other profession ever could. Have you noticed how quickly emotions show up once real money is involved? A trader can study charts for years and still be unprepared for the psychological pressure of risk. The moment money is on the line, logic competes with emotion. The market doesn't wait for you to feel ready. It puts pressure on your decisions and watches how you respond. Do you hesitate? Do you rush? Do you second guess? Those reactions have nothing to do with indicators and everything to do with mindset. The chart may be neutral, but your interpretation never is. Skill develops slowly. Mindset is revealed instantly. That's why two traders can trade the same setup and get completely different results. One follows the plan. The other interferes. One accepts uncertainty. The other demands reassurance. The market doesn't care which one studied more. It rewards the one who can manage himself. Can you follow your rules when the outcome is unknown? Fear is usually the first thing exposed. Fear of loss, fear of being wrong, fear of missing out. It shows up in hesitation on good trades and impulsiveness on bad ones. A trader afraid of loss cuts winners early and lets losers run. That's not a skill problem. That's a mindset problem. The market makes this visible very quickly. One look at a trader's equity curve often tells the psychological story better than any conversation. Greed follows closely behind. It disguises itself as confidence. A few wins create the illusion of control. Position sizes increase. Rules loosen. The trader feels smarter than the market. This phase is dangerous because it feels good. The market allows it just long enough to expose it. One sharp move in the wrong direction and the illusion collapses. The chart didn't change. The trader did. How do you behave after a winning streak? Impatience is another weakness the market reveals without delay. Waiting feels unnecessary when opportunity seems constant. Traders jump early, exit late, and overtrade because doing nothing feels like missing out. The market punishes impatience not with dramatic losses, but with steady frustration. Small losses, missed moves, choppy results. Over time, the trader feels confused even though the problem is simple. He cannot wait. Are you comfortable waiting when nothing is happening? The market also exposes discipline, or the lack of it. Rules look solid on paper. Execution is where they fail, the stop gets moved. The plan gets adjusted mid-trade. The reason is always logical in the moment. The result is always the same. Inconsistency. The market doesn't argue with your reasons. It only reflects your actions. Discipline is not tested when things go well. It's tested when the trade moves against you. What do you do then? Another mindset flaw the market exposes quickly is the need to be right. Trading is one of the few professions where being wrong is routine and unavoidable. Those who tie their identity to being correct suffer deeply. They argue with the market. They hold losing trades to protect their ego. They avoid exits because exiting feels like failure. The market is indifferent to ego. It doesn't negotiate. It simply continues. How much does being right matter to you? Confidence is also revealed, but not the kind most traders think. True confidence is quiet. It follows a process. False confidence is loud and reactive. It chases, it forces. The market exposes false confidence through volatility. When conditions change, the confident trader adapts. The insecure trader panics. Skill doesn't vanish overnight. Mindset does. Can you remain calm when conditions shift? Even patience with profits is a mindset issue. Holding a winning trade requires emotional control. Unrealized profit feels fragile. The urge to lock it in grows with every tick. Many traders exit not because the market tells them to, but because their nerves do. The chart didn't signal danger. Their emotions did. The market exposes this quickly. Large moves rarely belong to those who need constant reassurance. The longer you trade, the clearer this becomes. Most mistakes repeat themselves. Same fear, same impulse, same reaction. The market doesn't need to invent new lessons. It simply presents the same ones until they're learned. That's why traders often feel stuck. They improve technically, but results don't change. The missing piece is mindset. Are you learning from your behavior or only from your charts? The market also exposes self-awareness. Traders who reflect improve. Traders who blame stagnate. Every loss carries information, not just about price, but about decision-making, ignoring that information guarantees repetition. The market has no interest in your excuses. It responds only to your actions. Over time, patterns emerge, not just on charts, but in behavior. This is why trading is such a personal endeavor. You cannot hide from yourself when money is involved. The market sees you clearly, even when you don't. It doesn't care about intentions. It reacts to execution. That honesty is harsh, but valuable. It accelerates growth for those willing to observe themselves. Skill can be taught. Mindset must be developed. And the market begins teaching it from the very first trade.